Hello, everybody. It looks like people are coming in pretty quickly. It's just 11 o'clock, so we'll get started in a minute or two after people have a second to filter in. Hope everyone's having a good start to 2023. We're excited to host our first webinar of 2023 on a bill that was passed basically 3 days before the end of the year, and it was tucked into the $1.7 trillion omnibus bill. So there's actually a huge number of provisions that are in Secure Act 2.0. So we're clearly not going to hit all of them. I think there's over 100 provisions in Secure Act 2.0 relating to changing the retirement landscape, rules around qualified plans, IRAs, Roth IRAs. But the big theme of Secure Act 2.0 is that it's not really any surprise, but I think if we look at it through this framework, it will be helpful to kind of remember more of the changes, which is that the government is doing everything they can to incentivize people to save for their own retirement, because they realize that the average American just basically has very little saved for their retirement. I think the average is like $67,000 of total retirement savings balance. And so this bill is all about enhancing flexibility, incentivizing people to save, making the default option when you go into a 401k that you're going to automatically be signed up, so you'd have to opt out. So overall, we think the bill is good. It did have bipartisan support, and amongst the retirement industry experts, they feel like it's actually some very positive changes that took place. Nevertheless, as I said, it's just jam-packed with tons of things, some very inconsequential, some very consequential. So what we tried to do was pull out the biggest themes, biggest changes, particularly those that are really going to affect, the client base that we work with. So we'll do the same drill as always. What I'd ask you to do is, if you can hear my voice, see my screen and see me, if you could just either raise your hand or say, hey, from the chat box, that just lets me know we're not having any tech issues and people can see me. Okay, it looks like everyone can hear me all right and see me all right. So in addition, if you do have questions, we encourage you to ask those questions along the way. Some of them we'll be able to get to. Jeff and Jen are actually on the webinar as well, so Jeff can view your questions that you submit. If you would put those in the Q&A box, that allows us to read them, and if it makes sense to answer them for everyone, we will. If it's more of an individual question, we'll either answer it directly to you. Jeff will respond to your question, or if we need follow-up, we'll circle back with you after the presentation. So again, thank you so much, everyone, for coming. We're very excited to kick off the new year. Doesn't feel like much of a new year anymore. We're 24 days in, and the holidays seem like a long time ago. But nevertheless, first webinar of 2023, big retirement bill that was passed at the end of the year. They're dubbing it Secure Act 2.0. If you recall, at the end of 2019, there was a very big bill passed, and that was called Secure Act now 1.0, which made really material changes. The biggest one that a lot of you know about is, it used to be that if you had a retirement account and you passed away and you left it to your kids could inherit that as an inherited IRA, and they could stretch out the distributions from that IRA over their entire life expectancy. And now, or as a result of Secure Act 1.0 in 2019, that changed so that the limit was 10 years. They had 10 years to take it out, but after the 10th year, if they hadn't taken it out, there would be taxes and penalties. So that has stayed the same in Secure Act 2.0. But I just think that, again, the theme here with what the IRS is doing What the government's doing, rather, right, what the legislation was the government needs more money now, right? So there was a lot of fear amongst, people in the industry, clients about Roth IRAs going away, Roth 401ks, Roth 403bs, all of that going away because it's too good of a deal. And actually the opposite happened. Congress is trying to incentivize as much Roth as possible. Why? Because remember, with the Roth, you pay the taxes now and you get tax-free deferrals, right? And potentially tax-free distributions over your life. But so obviously short-sighted, because over the long term, if that much money is in Roth, right, they're not going to be able to get taxes from it. But right now their focus is actually, as much goes into the Roth as possible. We're going to incentivize or require you to put into a Roth, which we'll talk about, which increases tax revenue for the government today. So not terribly surprising, but I think if things are looked through that framework, more flexibility for American workers to save for retirement and accelerating tax revenue to the government now, those are the two big themes. And there's a saying you may read about called the Rothification of the retirement system. I mean, that truly is becoming a theme. And it wouldn't surprise us if that actually, that trend continues and they continue to make changes more towards kind of incentivizing people to put into Roth type of accounts. So quick disclosure, we go through this every time, but I think it's important to remember, obviously, we are not tax advisors, we're not attorneys, so this content is for informational purposes only. And in addition, 4J Wealth is a registered investment advisor. So unless you have some sort of agreement with us, I know there's some people on here who aren't clients, this should not be deemed to be, investment advice, legal advice, or tax advice. All right, so here's what we're going to cover over the course of today's webinar. And these we think are kind of the big highlights from Secure Act 2.0. The first is pushing back the requirement of distribution age, going over Roth-related changes. There's a new post-death option for a surviving spouse beneficiary of a retirement account. We'll talk about the new catch-up contribution rules. There's more relief, less severe penalties when a retirement plan mistake is made. We'll talk about some of the changes to 401k plans and enrollment into 401k plans going forward. And I think the last bullet's really important, which is what did not make it into the Secure Act 2.0 that a lot of people kind of thought they would make changes to. So we're going to go through all of that. And again, as you have questions, please put them in the Q&A box and we're be happy to respond. So here's what they're doing with the requirement of distribution age, right? You remember, before the first Secure Act, you used to have to take your first RMD at age 70.5. Then they pushed it to 72. Now what they're doing is if you're born between 1951 and 1959, your new requirement of distribution age will be 73. Okay. So if you turn 72, in 2023, you won't have to take your requirement of distribution. A month ago, your expectation was that you would have to take it, right? But for anyone who's already started taking RMDs, they have to continue. This is only applicable on a forward-looking basis. And so that's significant. What's more significant is for anyone born in 1960 or later, their requirement of distribution age will now be 75. So another way to look at this is the RMD starting age. It's also called required beginning age, is pushed back to 73 for those turning 73 between 2023 and 2032. And it's going to be pushed back to 75 for those turning 75 in 2033 and future years. This should say 75 here. Okay, but an easier way to think about it is just using this table, I think. So no retirement account owners will start RMDs in 23 or 2033 because of their age. In addition, it does not impact qualified charitable distributions, which you can start doing at age 70.5. And we have a lot of clients who make qualified charitable distributions. Not only did it not impact it, but the limit on QCDs, for short, was always $100,000 in a year. Now they're indexing that $100,000 for inflation each year. So over time, the amount you'll be able to do to a QCD once you reach age 70.5 will actually go beyond that $100,000 limit. And of course, because of the delay in which you have to take a requirement of distribution, it will provide a greater time frame where you have the ability to make Roth conversions, right? So let's say you retire, at 65, 66. Let's say you have enough money in savings accounts and non-retirement accounts to kind of get you through those first, 5, 6, 7 years. You could actually use that as an opportunity to make additional Roth conversions from your IRA to a Roth IRA. So it does provide some additional tax planning benefits for people who fit into that post 1951 date of birth. So I do want to spend some time talking about RMDs. This isn't specifically related to the Secure Act, but we have a number of clients who ask about how is an RMD calculated, what exactly is going on. We always do this calculation on behalf of our clients, but I thought it would make sense to really go through so you could understand how an RMD is calculated. So the first thing is it's always going to be based off of your December 31st IRA balance, right, for the previous year. So if we're in 2023 and you have to take a required minimum distribution by the end of this year, right? Doesn't matter whether you take it now or you take it December 30th. All they care is the money goes out by the end of 2023. What you would do is you would look to your IRA statements as of 12/31. Okay. Now, if you have one IRA, all you need to look at is that one IRA and you get the balance for 12/31. If you have multiple IRAs, right, you actually need to get the total balance between all the IRAs as of 12/31. Okay. So this is not limited to just, oh, I have these 3 IRAs. I'm just going to pick this IRA. It's any IRA that you have, not including a Roth. You do not have to take a required minimum distribution from a Roth. One other point here, if you have a 401k or 403b, in addition to your IRA, the 401k or 403b, the calculation is the same, but you have to take your RMD from the 401k or 403b directly, and then separately you have to take the RMD from your IRA or IRAs. Okay. So, but just in terms of from a formula standpoint, you get the balance as of 12/31 for the previous year. Then you look at the one of 3 tables. For most of you, it's going to be the uniform lifetime table. Okay. And you identify the factor that corresponds to the age you turn at the end of this calendar year. So the end of 2023. So you can see here is the table for the uniform lifetime table. You can see the ages going all the way to 103, and you can see these factors, right? These are IRS life expectancy factors. Then what you do is you divide the 12/31 balance by the factor, and that will equal the RMD that you have to take for the calendar year. So, for example, let's say as of 12/31/2022, right? Ending year balance from 22, my IRA had a value of $1 million. And let's say, as the IRA owner, I turned 74 in 2023, right? So I'm going to be 74 this year. So what I need to do is go over here and I see a factor of 25.5. So I take my $1 million balance divided by 25.5. That gives me $39,216. And that's what the RMD amount is. That's the amount that has to come out of the IRA, my IRA, by December 31st of this year in order to meet my required minimum distribution. Now, I'm just going to stay on this for a minute because it's been such a highly people really want to know this information. So I'm just going to spend a few more minutes here to make sure it's all clear. What if I had 3 IRAs that totaled 1 million, right? Same exact thing, right? The amount that I'd have to take out would still be the same because the total amount between the 3 IRAs is still $1 million. But I could take that 39,216 from only one of the IRAs. I don't have to take it pro rata from each of the 3 IRAs, okay? All they care about is I've accounted for all IRAs and I've taken out the right amount. The only difference, and I mentioned this at the beginning, is let's say I had $1 million in my IRA and then another 100,000 in the last 401k I had. And I never moved it for whatever reason. Retired, 74. There, I still have to take out this amount from the IRA, but I also need to do the calculation, 25.5 into the 100,000, and that would give me the amount that I have to take out directly from the retirement account. Another option would be to roll that retirement account into your IRA, okay, and then take it, just from one place, basically. But if you decide to keep it in an old retirement plan, you have to do the RMDs directly from that. It can't be aggregated the way the IRAs can. All right. Now, just to confuse you a little bit more, and I apologize for this, I do want to point out something called the single lifetime table, okay, also for RMDs. But this is used to calculate an RMD for beneficiaries of inherited retirement accounts. I die, right? My child, who's now, let's say, an adult, is the beneficiary, or my children are the beneficiaries. What they have to do is take out requirement of distributions, okay, over a 10-year period. But if they want to follow kind of the exact RMD amount, they would look at their age, right? They would look at their age, and then this is the factor that they would apply. So you can see here for a 74-year-old, right, if they're taking it from an inherited account, the amount that they have to take out is going to be much higher than the 74-year-old where it's based on their own IRA account, right? I wish this table had converted into percentages as well, but you could, 1 over 25.5 is a much smaller number than 1 over 15.6. This is like 7%, right, per year, and this is like 4%. So they're forcing you to take the money out of these accounts at a faster rate, right? In this example, and it makes sense. They're saying, well, wait a minute, person who started this retirement account is gone. So now the beneficiary is benefiting from this inheritance. We want to accelerate the money we're going to get from a tax perspective. And this can have an impact on your beneficiaries' tax rates, because if they're usually going to be working during this time as well when they're taking these, especially if they're getting it in their 40s, 50s, or 60s. Okay, so 2 different tables are used depending on whether it's your IRA or your spouse's IRA versus it's an inherited IRA. Okay. If you have questions on this, you can put it in the Q&A. All right, let's talk about some of the Roth related changes. Starting in 2024, there will be no requirement of distributions from Roth retirement plan accounts. Remember, for Roth IRAs, there have never been RMD requirements, but there have been RMD requirements if you had a Roth 401k or a Roth TSP or a Roth 403b. That's now gone, right? Meaning the decision to roll over an IRA, to roll over to a Roth IRA just to avoid the RMD, that no longer is relevant, right? So the decision to roll over is going to more closely resemble the decision of rolling over a traditional 401k to a traditional IRA. In addition, they're now allowing simple and SEP IRAs to be Roth. So you can have a Roth simple, you can have a Roth SEP. That was not the case before, right? And that's effective starting now in 2023. In addition, they're now allowing for, it used to be, let's say you had, someone starting out, they're in their 20s or 30s and they want to put into a Roth 401k, right? Now they're going to allow the employer, right, to contribute the employer match to go directly into the Roth 401k. Before, all the employer matches went into the traditional side, the traditional 401k, so the employer could get a tax deduction, right? So the employee would put into the Roth 401k, they would get a match, but the match would be on the traditional side. Now they're allowing employer contributions to contribute directly to the Roth account. And the employer still gets a tax deduction, which is big. That's why an employer will do this. The match, though, when you do it this way, the match would be taxable income, right, for the employee, which makes sense. That's how it works when you do a Roth 401k contribution on your wages anyway. So I think that's kind of an interesting thing. And then even more interesting is starting in 2024, if you make more than $145,000 a year, they are going to make you, if you do a catch up, you're over 50, you do the catch up, they're going to require you to do it into the Roth. Okay, that was a little bit surprising. So they're basically saying if you, right, the limit for 2023 for employee contributions is $22,500, and there's a $7,500 catch up. So a total of $30,000. If you're over age 50, you can put into your retirement plan, not IRA, your 401k, 403b, TSP. In 24, they're saying that catch up piece, that has to go to the Roth. It has to go to the Roth. Why? More tax revenue for them. At least that's our takeaway. Another big change for the that's in the Roth world, we'll call it, is the ability to do what are called 529 to Roth IRA transfers. These are totally new, right? So this wasn't around at all before. And I think it's not as big as some people think, but it is material enough to mention. This starts in effective 2024. The funds must be moved, if you want to do this, directly from a 529 plan to a Roth. And the Roth IRA that's receiving the funds must be owned by the same person as the beneficiary in the 529 plan, right? So if I'm the beneficiary of a 529 plan, and let's say there's money left over in the 529 account that my parents set up for me, okay, the transfer to the Roth would have to go to me, right? It's not going to my parents or parent as the owner. So that's a key consideration, and that kind of makes intuitive sense, right? The education account is for the child, the Roth IRA is going to be for the child. Now, here are the stipulations. The beneficiary must have compensation, right? So they must have some sort of earned income. Doesn't need to be a lot, but they must have earned income. In addition, the 529 plan must have been maintained for 15 years or longer. Okay. For those of you who are wondering, well, what if I change my beneficiary? They haven't clarified that yet. So it's unclear exactly how a change in beneficiary will be treated. So for now, let's put that on pause. But one thing that we talk about sometimes with Roth IRAs is even if someone doesn't want to contribute every year, just getting these plans started starts that time clock, right? So even if you do 1,000 in the 529 and didn't do anything for the next 5 years, you're now 5 years into that 15-year window, okay? So doing something to start that clock is very valuable. Any contributions to the 529 plan within the last 5 years and the earnings on those contributions, those cannot be moved to the Roth IRA. In addition, Roth IRA income limits do not apply. So if your beneficiary, the beneficiary is out working and making good money, this can still be, their 529 can still be transferred to a Roth even if they make more than the Roth IRA limit. However, each year, the amount that can be moved from the 529 to the Roth is no more than the IRA contribution limit, right? So, $6,500 in 2023. The maximum that can be moved from the 529 to the Roth for the beneficiary over their lifetime is $35,000. So, it's not a huge amount, but it's not insignificant either. And I think one of the key points is this last bullet is many people who are doing education planning for their kids. One consideration is, I want to save for their college. I know that there's tax benefits to saving through a 529, but they don't like that if the kid either doesn't go to as expensive a school or there's money left over, then in order to get that money back, they have to pay taxes and a 10% penalty on earnings, right? So there's like this risk of, oh, if I have too much money in there, I'm going to be penalized. So we believe that this reduces some of those risks for overcontribution to a 529 plan. And remember with 529 plans, and I think this is something that is easy to forget, is unlike most accounts, as it stands right now, let's say I'm saving for my kids' 529 plans. And my goal is not just to save for their 529s, but to say, I want to create a legacy where if my kids have kids, their college could be funded. So I'm going to overfund this. So in that example, even if it doesn't transfer to a Roth, the 529 beneficiary can go from my kids, right? And then it can be changed from my kids to actually to their kids. And it can continue to pass down the generations. Now you have to, of course, have the money to put in there to do that and save enough. But just as an estate planning vehicle, it's extremely effective because you could essentially have a pool of money, devoted to education funding that grows tax deferred, right? And as long as it goes out for college, goes out tax free. And that compounding effect can happen, if it's going multiple generations over decades and decades. So it can be very, very, very material. So just something to think about. But this is a pretty big change. And something we're excited about from a planning opportunity. Okay, another significant change, and this is going to get a little bit in the weeds, but there's, let's say you're married and your spouse passes away. It used to be you could keep it in their IRA and you become kind of the beneficiary. It becomes an inherited IRA, or you could just take that money in the IRA and roll it over into your own IRA. So starting in 2024, they're going to allow you to elect to be treated as the decedent for RMD purposes. So even though it's a beneficiary IRA account, the rules would be as if the spouse, right, had essentially not died. So what are the effects? RMDs can be delayed until the deceased spouse would have reached RMD age, right? Let's say I'm 70 and my spouse is 65, and God forbid my spouse passes away and she had an IRA. Well, I could elect to be a surviving spouse beneficiary. And even though I would have turned 70, 72, 73, and would have normally had to start taking RMDs, I can wait until my spouse, would have reached RMD age. And in addition, the way that the RMD is calculated is going to use the uniform lifetime table versus the single lifetime table. So let's go back for a sec to show you why that's important, right? If I'm, let's call it 78, let's call it, by the time these distributions need to start, I can use this uniform lifetime table versus under single life expectancy, I'd have to use a factor of 12.6, which means I'd have to take it out much more rapidly, which would accelerate and increase and potentially increase my tax liability. Okay, so that's why that's a significant change, is that you can do it under the uniform lifetime table. This gets, I think, where it's just a little too much, but we included it. If the surviving spouse also dies before RMDs begin, the surviving spouse's beneficiaries, right, will be treated as though they were the original beneficiaries. So just something to note there. So I think, pretty good rule of thumb is if the spouse is the sole beneficiary, the spouse is older than 59.5 and older than the deceased spouse, then elect to be treated as a decedent under the Secure Act 2.0. That's a pretty good rule of thumb, but obviously every individual case is different, and we're happy to discuss that with you. All right, let's talk about some new catch-up contribution rules. So in 2023, right, the limit to put into an IRA or a Roth is $6,500 per year, and you can do an additional $1,000 if you're age 50 or over, right? Starting in 2024, they're finally going to index the catch-up, right? That $1,000 that hasn't moved in a long, long time, they're going to start indexing that for inflation in $100 increments. So that catch-up will also start moving up. In addition, Congress seems to really like those aged between 60 and 63, probably a huge portion of their constituency. But if you're 60, 61, 62, or 63, starting in 2025, you'll be able to do a catch-up the greater of 10,000 or 150% of the 2024 catch-up limit, right? So the catch-up limit right now for 401k is 7,500, in 2025 it would be at least 10,000, and that will continue to increase based on inflation, but only for this small subset of people. Okay, so I don't know why they make the rules. I'm just telling you what the new rules are. They also showed some leniency around retirement plan mistakes, relief for retirement plan mistakes. So you remember the penalty if you missed your RMD, like you were supposed to take it at 72 and you forgot, and then you got around to it the next year, the year after. It used to be you'd have to pay a 50% penalty plus tax. Massive, massive penalty. It's now reduced to 25, and if the correction is made within 2 years, the tax can be further reduced to 10%. Another thing worth mentioning, and there's a bunch of these kind of little things in the bill. There's an exception for early distribution penalty for distributions to participants with a terminal illness. So they still pay taxes, but there's no 10% penalty. It's considered terminal if a physician certifies that the illness is reasonably likely to result in death within 84 months. Okay. Other relief doesn't apply to that many clients, but I do think it's important, and we think it's worth mentioning. Prohibited transactions in IRAs. So things that are called self-dealing. So maybe you borrow from an IRA or sell property to it. Let's say you have an investment piece of real estate in a self-directed IRA, and you decide you're going to go use that property for personal use. That's a prohibited transaction. Having investments in collectibles, art, antiques, prohibited transactions. So traditionally, if the IRS caught that, okay, not your entire IRA balance, right? Whether it's this IRA or every IRA you own, it would essentially blow it up and you'd be subject to tax and penalty. Now, in the event of a prohibited transaction, only the IRA that was the source of the transaction, right? So if I have an IRA over here that's in traditional investments, stocks and bonds, mutual funds, and then an IRA over here where I own a piece of real estate, and I violate the rules on the real estate, this is saying that while it will impact where the real estate is owned directly, right, that will face penalties and tax, but the other IRA that's held separately would not be lumped in with that. So again, a lot of these things don't apply to many people, but if it does, impact you, it's pretty significant. Other changes to allow more flexibility. There's a student loan perk. So this is I think pretty interesting, and again, kind of tells you where Congress is going and what they're thinking in terms of retirement and the debt. There's a lot of young employees out there that have a huge amount of student loan debt. And so what they did as a part of this bill was, starting in 2024, employers will be able to match contributions to the employee's 401k or retirement plan on behalf of those employees who are making payments to student loans rather than contributing that money to the employer plan. Right? So it's basically recognizing that some people can't do both and they have to pay off their student loans. So that's where their money goes. And this basically is saying, look, we're gonna match whatever you pay off the student loan in a given year, and that match is going to go into your 401k plan. Okay. So I think I'm sure there's limits, and they're going to clarify more of these things. The bill's only 3 weeks old. But I think that's a pretty significant and positive change. They're also allowing for participants to have kind of an emergency savings portion of their 401k. I think a lot of our clients would be shocked by the number of employees working for small businesses who are just getting by, and they have to take a loan from their 401k because some unexpected expense popped up, and that's the only money that they have. And so what the Secure Act 2.0 allows is for plan participants to withdraw up to $1,000 annually for meeting unforeseeable or immediate family needs, right? Like a family emergency. These distributions will not be subject to a 10% penalty, even though they're before age 59.5. The catch is only one distribution can be made per year. And if the employee does not repay it, then they have to wait another 3 years before they can take it again. If they do repay it, they repay it within 3 years, they can take $1,000 each year if they needed it. But that doesn't probably seem significant to many of you. Just, oh, $1,000, like that's not going to pay for much. But for a lot of people, that's actually huge. And if that can get them over the hump to say, yeah, I'll put money into my retirement plan, then that's great. Okay, on the 401k side, kind of the employer side, any new 401k and 403b plans have to include an automatic enrollment feature. Kind of interesting. And that automatic enrollment must be at least 3% when they start, not more than 10%. And then each year it will escalate by 1% up to a maximum between 10 and 15%. So I'm starting at a new company, let's say, okay? I don't know anything about 401ks. The default is going to be that 3% of my paycheck, right, when I start is going to go automatically into the 401k unless I opt out, right? So the Congress is aware kind of the inertia of humans, especially around retirement savings. And they know that if the default is to go in, most people won't opt out, right? And so this is encouraging people in not a forced way, but nudging, really strongly nudging people to put into their retirement. Why? Because pensions have gone away, and the only other source of retirement income they're going to have is Social Security. And the reality is Congress is looking at that probably over the next 30, 40 years and thinking for the people who are in their 20s, 30s, 40s today, that system, right, may not be able to be relied upon the way it is now. And so they're doing everything they can to kind of shift the retirement income responsibility to the individual. And this is another version of this. I do think it's a positive, right? They can still opt out. But if you don't opt somebody in, right, and they don't know anything, they're just never going to do it. They're never going to do it. And then, when the time comes, they're going to, look and see what they have. And there's basically just not going to be enough there. So step in the right direction. Obviously, we need a lot more work on retirement and the education around saving for retirement, especially to people kind of in the low to middle income range, because those are the people that are truly left behind here. All right, so let's talk about some things that did not make it into the Secure Act, right? Not into Secure Act 2.0. There was a lot of rumors. Many of you might be aware there's kind of a famous Roth IRA situation. The guy named Peter Thiel is a little controversial, but he runs Palantir, and he was one of the founders of PayPal. He was on the board of Facebook. Anyway, he put somewhat of a small amount of money, and I think he bought Facebook stock very early on in his Roth. And it's now he has billions, I think 5 or 6 billion in his Roth IRA, which I know it's kind of incredible that a billionaire has billions in something that he's not going to face any income taxes on. But so the rumor was that Congress is definitely going to impose some rule that's going to either limit how much can go in it or force money out once you reach a certain threshold. None of that happened. None of that happened. It was kind of shocking. And that tells you how much they are focused on collecting tax revenue now and continuing with this trend of Rothification. So they limiting the use. There was talk about them maybe limiting the use of backdoor Roth, right? Roth conversions or mega backdoor Roth conversions. Didn't happen. Placing new limits on who can make Roth conversions. Didn't happen. Creating non-age-based RMDs, right? So if someone had over 2-3 million in a Roth, they have to start taking out a certain amount. each year. That wasn't in this at all. People thought that there might be a change to the age at which QCDs can be made, right, to match it up with the RMD age, and they didn't. They left it at 70.5. This is a little bit nuanced, but qualified small business stock, right? You're a self-employed individual, you know, your company has value, you own stock, you could put that into, retirement account. They were talking about restrictions on that. That didn't happen. Eliminating new types of investments, like being eligible to be purchased with IRA money, like private equity, private real estate, right? Something that's, where it's a self-directed IRA. And then the last bullet I think is huge, is they did not correct or clarify the way the 10-year rule created by the original Secure Act should be implemented for non-eligible designated beneficiaries, which is most people, right? Beyond their spouse, it goes to their kids, right? Anyone who's a kid, unless, they have some specific issue, they have to take that money out over those 10 years. And what needed to be clarified and wasn't was, let's say I'm 80, so I've already been taking my requirement of distributions, and I die. My spouse is already gone. My kids are the beneficiaries. Can they not do anything and then take all of the money out in year 10? Or do they have to continue to take the RMDs, right, based on, the fact that RMDs are already being taken? That's how it normally works. They have to take the RMD, and then in addition, by year 10, everything has to be exited. They didn't provide any guidance on that. And they didn't provide any guidance on it in 21 and 22. And so there were a lot of people who didn't take the RMD amount, even though they, arguably should have. And IRS or Treasury came out and said, we're waiving any penalties for people who didn't take the RMD in 21 and 22, basically because they hadn't provided any guidance. The same thing's going to happen here. The law was just passed. It's going to take time for them to provide clarification and guidance on some of the rules that they probably don't all understand. But this is a big one. So we have to assume, if RMDs were already being taken and the IRA owner passed, and now you have a non-eligible designated beneficiary, like a child, like a kid, even if it's an adult kid, that we have to continue to take RMDs out each year based on the single life expectancy table. And in addition, that the entire amount has to be emptied in 10 years. Maybe they come back and say, no, you don't have to do the RMDs. You can take it out however you want, as long as it's all out by the 10th year following the year of death. We don't know yet. So that's kind of a TBD situation. But to err on the side of caution, we're just going to assume that we have to do those RMDs each year, so that if they say, no, you do have to take them, and those who didn't are penalized, our clients won't fall into that. Okay. Are there any questions? This is, again, there were 100 different provisions in this bill, and not all of them are hugely relevant. So we tried to pick out the biggest ones. But are there any questions? And if there are, go ahead and put them in the Q&A box. Well, that can mean one of two things. It was either such a good presentation that it answered all of your questions, or it was it was so kind of in the weeds that no questions. You don't have any questions on it. Either one's fine. But again, we will have this webinar is being recorded, so we'll send it out and make it available to you in a couple days. If there aren't any questions, now there are questions. So Jeff, if you wouldn't mind kind of reading out the questions.
Sure. There's one comment just kind of saying it was very interesting and the presentation was great. There's another question. All inherited IRAs are the same. Are all inherited IRAs the same? For example, sibling inherited versus child inherited.
Good question.
So that's a great question. Josh, you want to?
No, go ahead. Do you want to answer it?
No, go for that.
So yeah, so with a sibling, as long as the sibling is not 10 years younger than you, then they can actually take the RMD out based on their life expectancy. So it's not subject to the 10-year rule if the sibling is less than 10 years younger than you, right? So right, and that think of it this way: if you have a sibling who's 20 years younger than you, right, it's kind of abusing the privilege for them to be able to extend it over their life expectancy.
I think there's one small kind of nuance there is if the child that's inheriting it
No.
is disabled. So that
Correct.
enables
That
them
is.
to stretch it over their lifetime. But
Well, yeah. I think if the child, I think the way that works is if the child is disabled, then yeah, I'm sorry, you're correct. You're correct. I apologize. Yes.
we have another request. Can you show the RMD slide again? I'm a little confused about the age thing.
Sure. So let me go back there. Oh, there we are. Okay, so here's the RMD table, and on the left is kind of how it's calculated. So this, again, for anyone who owns an IRA, it's if your spouse is more than 10 years younger, you get a little bit of preferential treatment. You use a joint life expectancy table, which you don't have here. But as long as your spouse is within 10 years of your age, you're going to be using this for your IRA. So what is the question on that?
Just there was no specific question. Nancy, I don't know if you want to type in a specific question you had on the slide, but she just said she was a little confused about the age. I'm not sure if that means the divisor.
Oh, I see. Maybe. Okay, so for 2023, it would be the age you turn by the end of the year. That's the age you're using to figure out what factor to.
Right. So she says, I will turn 73 in December. Do I have to take the RMD this year?
So she turned 72 last year then?
Yes.
Yeah, so she unfortunately has to take well, she shouldn't take an RMD last year and then this year as well. Yes, no, that she just that's like literally missed the window by a couple weeks. Right, because that means she was born in or whoever asked the question, born in 1950, right? And if it's less than 1951, then they don't. She has to take an RMD this year, just like she took one last year. Does that answer the question?
Yes.
Okay.
Yes. Thanks. Okay.
Anything else?
I don't see any additional questions.
Okay, awesome. We will know more, as time goes on and they clarify things. I think we'll know more, but look, these are significant changes, and there are a lot of you, we know who might be retired, aren't yet required to take from their IRA, or now they were going to have to take at 72, and now they don't have to take to 73 or even 75. Those are all planning opportunity windows. Okay, and so we will make sure as part of our reviews when we sit down with you that we incorporate these new rules into the planning. If there are no other questions, I don't want to push anyone to ask a question they don't want to. We sent out important kind of tax updates for 2023, like important numbers to keep in mind. So if you want, if you'd like a copy of that, we can definitely send that to you. You should have gotten an email, but if you missed it, it's just I can show you. Let's see here. If you take a look here, so we sent this out, but it's just a really nice summary of a lot of the pertinent numbers that impact taxes, Medicare, right? So you have the tax rate, married, family, joint, and single. You have taxes on long-term capital gains, what rate it's in, depending on what the income range is. You have your IRMA, right? If you're on Medicare, how much of a surcharge you're going to have based on your income from 2021. The wage base for Social Security, the taxation of Social Security went up to 160,200. There was also a COLA for those of you who are getting social for 23 of 8.7% increase over last year. These are the new standard deduction amounts. And then down below, this is where we took the uniform lifetime table and single lifetime table. And then here are all the limits for your 401k, 403b contribution, catch up, IRA, Roth IRA contribution and catch up. When you phase out to be able to contribute, not convert, but contribute to a Roth. And then when you phase out for being able to deduct money to your IRA. So then how much you can put into your health savings account if you're doing that. So again, lots of good info. Happy to send this out to anyone who wants it. I know we're finishing a little bit early, but that's okay. So thank you everybody for attending, and we're available for questions, and we will see you next month, if not sooner. All right, take care. Bye-bye.